Thank you for tuning in. I am your host, Joseph Martin. Hit that like and subscribe button to support the channel and hit that bell icon to receive notifications. Before we get into today's topic, I would highly advise that you watch the first video we did on whole life insurance. I'll put a link for it up on the screen and down in the description. In that video, I mentioned that the loans taken out against the cash value of a policy had a fixed interest rate. Guys, this isn't always the case. In fact, it depends on your policy. Some companies do allow you to choose how you want your loan interest to be during the application process when you first set it up. Some agents don't even know this because most clients don't ask about choosing a specific interest for their policy loans. There are 3 ways to figure this out. 1, research the company to see if the information is available online. 2, contact the company's customer service and ask. Or 3, ask your agent. The interest rates on a policy loan are usually below 7%, which is often a lot lower compared to a cash advance on a credit card or an unsecured loan. Life insurance is one of the wealthy's best kept secrets. The reason why is because they've learned how to access money within these types of policies while they're still alive, making them a powerful asset in their financial strategy. I've bought and read 4 books on how to get the most out of life insurance policies. I also purchased a course for almost $2,000. And all I learned was that a whole life insurance policy could have major benefits you can access while you're alive, but only if it's set up correctly. In the past, the only way for you to get a life insurance policy was through an agent, but the market has evolved. Now you can get a policy DTC, which stands for direct to consumer. This process is automated where you answer some questions about your health, your lifestyle, etc., and get an instant decision online. A life insurance agent who knows, understands, is willing to share the information and do the work necessary to structure the policy properly would be ideal. But the truth is, financial advisors know more about life insurance policies and how to structure them properly for their clients' needs compared to insurance agents. So all of these resources, books and courses that are supposed to teach you only try to sell you. They want you to buy the whole life insurance through them because they're usually life insurance agents. If they told you exactly what you needed to do to set it up and structure it yourself, you wouldn't need them to do it for you. So since they don't want to miss out on earning a commission for selling you the policy, they tell you just enough to make you want to buy it from them. But before we go any further, this is not financial advice. Read the disclaimer in the description. Let's get to it. Lesson number 1, term versus whole life. When someone shops for life insurance based on price and not a financial strategy, they might make the mistake of purchasing term life insurance. That's because a term life policy is usually a lot cheaper compared to a whole life policy with the exact same death benefit. The first reason it's cheaper is because the term policy usually expires before the insured passes away. A whole life policy covers the insured their entire life and doesn't expire as long as the premiums are paid, unless the insurance company discovers you misrepresented or something wasn't disclosed on the application during the 2-year incontestability period. This is the time a life insurance company has to void the coverage and refund the premiums paid instead of paying the death benefit. Since the chances are higher that the death benefit will be paid out in a whole life policy, the premiums are more expensive. The term life policy expires because it only covers the insurer's life for a certain length of time. 10 years, 20 years, 25 years, for example. It all depends on the term life insurance policy. The other reason term policies are cheaper is because they don't earn cash value. And since a life insurance policy needs to have cash value in order for you to borrow from it, you can't take out loans. So having term life insurance can be a financial strategy, but the key is that it's a temporary financial strategy. and is limited compared to having a whole life policy. Which brings us to lesson number 2. There are different types of permanent life insurance. Terminology time. In the life insurance industry, they refer to different types of policies that they offer as products. And remember, we are focused on mutual companies, not stock companies, which we covered in the first video about whole life insurance, because the mutual companies pay dividends, and those dividends can be used to do any of the following things. It can be used to pay the owner of the policy tax-free, which the industry defines as a return of the premium, so it's not considered a profit. It can be used to purchase more life insurance, which accelerates the growth of cash value. And it also can be used to fund certain riders you may add to your policy. I know we haven't discussed riders yet, but we will in a future video. Depending on the company you choose to go with, they might have different names for their permanent life products compared to other companies. Names like Universal Life, Variable Universal Life, Whole Life 100, for example. Don't let these names overwhelm or distract you. This is where your education and having the right agent or financial advisor comes in. All of those products are permanent life insurance, but they aren't all whole life products. You can recognize a whole life product because it will have both a fixed premium and a fixed interest rate for growth. This is the growth on your cash value, not a fixed rate on the loans you would take out against the policy. Whole life products will have all 4 roles we discussed in the previous video. Those 4 roles, just as a reminder, is the owner, payor, beneficiary, and the insured. But it also has the cash value, insurance coverage for the entire length of the insurer's life, and dividends. The only difference between them is the schedule for paying the premiums, which brings us to lesson number 3, premiums. Something none of us needs when it comes to bills are surprises. It's easy to plan for a bill when you know it's coming, but it's easier to plan for it when you know exactly how much it's going to be. All whole life products have fixed premiums, but different types allow you to choose how long you want to pay for the entire cost of the policy. This insurance term is called paid up when the policy has been paid in full or when it will be. A limited pay whole life product gives you the flexibility to choose a payment schedule with less premium payments. Now, less doesn't mean that the policy will be cheaper. It means that the policy will be paid up sooner. So the premium payments become higher the quicker you pay for the total cost of the policy. For example, if you had to pay $10,000 for a policy over 10 years, then your monthly premiums would be $83.33. But if you chose to have the $10,000 paid up in 5 years, your monthly premiums would be $166.66. So the policy doesn't cost more. The premiums are just higher because you're paying for it faster. That way, you have fewer premium payments. The industry would call this accelerated funding, when you choose a payment schedule that reduces the amount of time that it would take you to have the policy paid up. Each company will have their own brand name for the products. For example, all limited pay whole life products are sports cars. So Chevrolet has the Corvette, but they also have the Camaro. Once you've chosen a whole life policy with a payment schedule, you never have to worry about the premiums increasing for any reason as long as you're making the payments. Lesson number 4, interest rates. There are two types of interest rates in a whole life policy. There's the interest rate that the cash value grows and the interest rate you pay on a loan. The interest rate on the cash value is the guaranteed rate of growth, which is fixed. This is one of the main reasons this type of policy is such a powerful asset. You don't even get a guaranteed fixed rate of return in something that tracks the S&P 500, which contains roughly 500 of the largest companies in the U.S. stock market. In the first life insurance video, we talked about taking loans out against the cash value of a whole life policy, but we didn't talk about the interest rate you'll be charged on the loan. Quick economics lesson to explain why this is so powerful. Whenever you take out a loan or use credit, it's usually with what's called a variable rate, which simply means it changes. The Federal Reserve, who are simply referred to as the Fed in finance, adjusts interest rates in an effort to keep the economy stable so it won't collapse. This matters because the higher the interest rate, the more expensive and difficult it becomes to take out a loan or use credit. Since some life insurance companies allow you to choose a fixed rate for loans when you apply for the policy, you'll know exactly what your interest rate will be no matter what the Fed set as the national interest rate. And even if you do have a variable rate, as I mentioned earlier, it's usually around 7% or less. This could potentially save you hundreds, even thousands on interest depending on the size of the loan. Lesson number 5, discounts. My family has been throwing away money for years because of ignorance, simply not knowing. Insurance companies offer discounts, and some more than others, depending on how you make your premium payments. I recently found out that one of the companies we have policies with, if we had set them on auto pay, we would have received roughly an 11% discount. Some companies insist on setting up auto pay so they can take premium payments directly out of a checking or a savings account. But it never hurts to ask if there are any discounts you can receive based on how you pay your premiums. If you currently have a policy that you're still paying online or mailing in payments, you could be missing out on savings, or at the very least, the convenience of having the premium set up on auto pay so you don't have to worry about missing a payment. Another benefit is that instead of paying your premiums monthly, you can pay them quarterly, biannually, or annually. Now, why in the world would you do that if it ends up costing the same? I'm glad you asked. Making larger premium payments gains more interest sooner, accelerating the growth of the cash value. So even though it's the same amount of money going in, it's not the same amount of growth. For example, let's say your monthly premium is $50. That would be $600 annually. If you were compounding interest from those monthly payments of $50 at a 5% annual rate accumulated monthly, you'll earn about $13.94 that year in interest. But if you made one annual payment of $600 because you're accumulating interest on that larger one-time payment monthly, you would earn $30.70 for that year in interest. So you'll earn more than double in cash value with the same $600 of premium versus breaking it up into 12 payments. Life insurance companies also charge fees for making more premium payments in a year, and it's called a modal charge. The idea is there are more administrative and billing costs for 12 payments than it is for 4, 2, or 1 for that year. These modal charges come out of the premium payments and reduce the amount of money that goes into your cash value, which you should understand hurts your growth now. You need to understand that the more of the annual premium you pay up front maximizes the growth in your cash value. Remember, it's free to ask insurance companies about the different ways you can get discounts paying premiums. Find a balance between what you need and what you can afford, factoring in the discounts for the cost. You already know I hope that you learned something, and I hope that you earned something. Hit that like button and put your thoughts down in the comments. Let me know what you guys think. Make sure you check out my other two channels, Original Greatness Shorts and Original Greatness Uncut. Make sure you stay tuned for part 3 on whole life insurance and check out the next video. Take care and God bless.